Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Monday, the 17th of March. I'm Daniel Lam, your host for the podcast. The debate continues. Do you want to chase the year-to-date outperformance in European and Chinese equities? Or do you want to go for the lagging US equities? Well, I want to show you some interesting statistics that our CIO team did. Now, since 1970, the S&P 500 index had 24 instances of correcting by more than 10% from its all-time high. Now, in 7 of these instances, it was followed by a recession. The S&P 500 would go on to deliver an average return of 2.3% and 1.9% over the following 6 and 12 months. Now, if there were no recession to follow this correction, the average returns would be 10.8% and 14.4% over the following 6 to 12 months. Unconditionally, the S&P 500 would deliver an average return of 4.6% and 9.4% over a 6 and 12-month period. So overall, we can say that a recession occurs in the minority of cases following such pullbacks. And US equities generally go on to deliver better than expected returns following a 10% pullback if the economy can avoid a recession. Returns will be lower if a recession materializes, but nonetheless still positive on average on a 6 to 12-month horizon. So what does that mean? It means that buying US equities at the current level has attractive risk-reward for the medium to long-term holders. Now, like what we said on Thursday, we're beginning to see some bargain hunting for the Magnificent Seven stocks, which is the usual behavior as market attempts to bottom out, and the largest stocks would be taking the lead. In some of these stocks, we're even seeing some capitulation volume, i.e. the spike in volume falling into important support levels, and then big volume coming in to buy the stock in what could be a change of hands into bargain hunters. Now, what needs to follow now is a stabilization of macro data. We've seen reasonable non-farm payroll and CPI figures. If we continue to see data coming out of the US that appears to be okay, then we can see economic surprise indicator picking up, while the better sentiment in Europe would be leading to high expectations and thus tougher mark to beat. This can lead to potential rotation of funds back into US equities from the rest of the globe. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.